what are your questions? So let's go through them, or should I go through them along the way? How should we do this?
Uh,
Yeah, tell me what your questions are, and then I'll answer them along the way. Okay, so that would be better.
main basically, if a
Direction.
range is confirmed, then I will doubt where we can sell, where we can buy.
Yeah, I'll show you. Okay, and
Let's start. I will ask.
okay. Yeah, let's do it.
Okay.
Okay, so first thing now you know what strong highs and lows are, right? So something like this. This right here is what we call a strong high. Okay, this is what we call a strong high. So
Liquidity grab,
yeah,
breakup structure.
yeah. So stop loss has to be liquidity has to be taken out, and then structure has to be broken like this. Okay, so once that happens, this right here will be what? A strong high. Okay, this will be a strong high, and same thing, this will be a strong low. Now remember, this formation is very important. Okay, this will be very important. Like some people call this the QM and all that stuff, right? A bullish and a bearish QM. So yeah, whatever
I
name you
heard
want to
that
call it, but
some.
like as long as you understand the logic behind it, it's more than enough. Okay, so something like this is a strong high, and this right here will be a strong low. Okay, this will be a strong low. And also now when I say liquidity has to be taken out, like it doesn't have to be equal highs all the time. Okay, or else it doesn't have to be trend lines all the time. Now yeah, this could be taken as liquidity, but it doesn't have to be this, because now you know the three candle formation, right? For a swing high and a swing low. I think I would have gone through that. Yeah,
Yeah.
yeah, you know that, right? So
Yeah.
if it just runs above one single swing high and gives you a break of a swing low, that's more than enough. Okay, that's more than enough. And remember, for the breaks, we will not be considering the wicks. Okay, so it has to always be with a body closing. Okay, you get that right. Now those days I used to use the wick breaks too, but we're not going to do that anymore. Okay, we'll be using body breaks only because they are way more accurate than the wicks. Okay, so yeah, something like this. And yeah, you know how these inducements and stuff works, right? Like let's say we had something like this. Yeah, let's go through this quickly and then let's get into the other topics. Okay, so let's say we had something like this, and yeah, maybe the market gave you a little retracement and another break. Okay, so now if you look at basic market structure, what can we see? We have a lower high, right? A lower low, another lower high in here, and then another lower low, right?
Low,
So
low.
yeah, this is just basic market structure. So you know what everyone does, right? Now, if they want to re-enter, they will also expect another lower high and lower low, right? Because
Lower
it
high.
makes sense, because this is what makes sense to do, right? So yeah, everyone will be doing this. Everyone will be doing this. But so now, first thing, what will smart money traders do? Like they start looking at order blocks and now all the stuff in here, right? They start looking at order blocks or
Yeah.
something in here, like sell it here, stop loss above this and stuff, and then target lower prices. This is what the majority of them would do, right? And not only smart money, even supply and demand, right? Even supply and demand, and not only them, you know now what else? Trend lines, right? Trend line traders are also expecting the same thing. Maybe a move like this and then a drop, right? They're also expecting the same thing. And yeah, not only them, break and retest, support and resistance. And since this high right here is a swing high, what do we have above that high? Buy stops, right? Buy stops are resting above every single swing high in the market. Okay, so now yeah, if you know ICT, yeah, you probably know him. So ICT tells you that liquidity is what? It's something like a magnet. Okay, liquidity is something like a magnet, and price is like a paperclip. What happens? It always draws towards the magnet, right? This is what happens. So you have to
Yeah.
always know where the draw on liquidity is, always where is the liquidity resting. So what do we mean by liquidity? Liquidity means the stop losses and the pending orders that are resting in the market. Okay, so now in this price action, in this bit of price action, where is the most amount of stop losses resting? It is right above that high, right? We know that. Okay, most amount of
Lower high.
liquidity, yeah, it's resting right above that high. So is it safe for us to sell here with our stop loss above that high? No, right? It's not safe. So what we do is
No.
we look for a point of interest above it. Okay, above it. So this is what we do. Now remember, now when it comes to POIs, okay, now there'll be so like we have refined the way we used to look mark the
I have
POIs.
a
Okay, so
problem with the POI
yeah, I'll
selection.
show you. Okay, I'll show you because like the way we mark out the POIs right now are completely different from how the smart money traders mark it out. Okay, so I'll show you. So
I trade in Euro USD. I have a screenshot of this. I just
okay.
practice the trade. Uh, Around I
Yeah,
watch
let's go
league
through it. Let's
videos.
go through it. Okay, so yeah, let's go through it. Okay, so now like right now,
Uh,
now just forget whatever you learned from the previous ones. Okay, because right now we'll be doing something that's way more different. No, not very different though, because I'm not telling you to jump from one strategy to strategy. No, this is a refined version of it. Okay, some advanced version of what I
Okay.
already used to do. Okay, so using ranges and all that stuff, but the way we mark out POIs will be completely different. Okay, so that will be different. So now one thing, now we'll only be marking out just two types of POIs. Okay, one will be imbalances. Okay, so you know what imbalances are, but remember, imbalances are not
Yeah,
that
yeah.
important. Okay, imbalances are not that important. The most important type of POI will be the closing prices of candles. Okay, it will be the closing prices of candles. I will show you examples. So now, like, which means now, first thing, like, how are order blocks formed? So let's go through it. Okay, let's go through it. So now let's say maybe we had equal highs. Okay, let's say we had equal highs like this. Now, what will the retail traders assume? Most of the retail traders would assume that a double top is a sign of a reversal, right? A double top is a sign of a
Yeah.
reversal. So what will they do? Once this breaks, they'll expect a move like this, right? They'll expect a move like this. So what will
Yeah.
they do? They'll sell it with their stop loss above those equal highs, right? This is what most of them would do. Now, not only them, some people would call this the M formation. Some people would call this a strong resistance and all that stuff. So whenever price goes here, they'll be expecting it to drop, right? They'll expect the price to drop. But now there's smart money, right? Smart money knows that there's a pool of liquidity resting above that high. Okay, they know that there's a pool of liquidity resting above that high. So what they do is now, whatever retail traders do, smart money traders will do the opposite. Okay, so when retail traders are selling here, smart money traders will start buying it. Okay, they'll start buying it. Like, why are they actually buying it? That's only to take out the stop losses that were resting above that high. Okay, so after taking out the stop losses, what will they do? They'll start selling it once again. Okay, they'll start selling it once again. So now what's happening though? Okay, what's happening? So now smart money, they bought it in here, right? They bought it in here to push price back up, right? So this move right here is what? This is a forced move, right? This right here was not a right move. This was a forced move made by whoever that runs these markets. So now what's happening is when the market is moving down, the buy orders that they placed in these areas are in a drawdown, right? The buy orders that smart money placed in these areas are now in a drawdown. Okay, so now they don't
Yeah.
have to use stop losses because their pockets are deep. Okay, they do not use stop losses like us because they can always move the market. Okay, they can move the market. So what they do is they will push price back up into those areas where they earlier bought it from. So this right here is what we call a mitigation. Okay, mitigate out of their losses and then once again push the market back down. Okay, so what's the order block in here?
Recently,
What's that?
can I speak? Recently, it's in Euro USD.
Yeah. I'll show you examples. Okay, so people will be expecting like this is what we can expect because this right here is what we call a mitigation. So what is the order block in here? Now remember, an order block is not a candle. Okay, an order block is not a zone. An order block is a specific price level. Okay, so what is that price level? Now, remember that very well. Okay, an order block is not a candle. Okay, it is not a candle. It is not a zone. It is a specific price level. So what's the price level? Like it will be the opening price. Okay, the opening price of the bullish candle that did the manipulation. Okay, so you can take it that way, or else I will show you examples that way you'll understand it. So the opening price or as the closing price, I'll tell you why you should focus on the closing price. Okay, so simply an order block is a specific price level. Okay, can you understand that the price level that they use to push the market up like this? Okay, so that will be your order block. So remember, an order block is just a price level. Okay, it is not a candle. It's wrong. Okay, it is not a wick. It is not a. It's nothing. It's just a price level. Okay, so something like that. Can you understand that? Hope that's clear. Okay, so yeah, and the next thing
Yeah.
is now what's the breaker block? Okay, what's the breaker block? Remember, like a higher time frame order block is always a lower time frame breaker block. Okay, so
Breaker block.
yeah, a lower time frame breaker block. So what's the breaker block? The breaker block will be the last down candle before the manipulation. Okay, the last down candle before the manipulation is what
Before
we
the
call the breaker block. So rather than having the whole area marked out like this, you can always refine it to the breaker that might be in here. Okay, so something like this. So this is what we call a breaker block. But remember, now after today's session, you will not call it order blocks or breaker blocks or rejection blocks anymore. Okay, we'll just call it closing prices. Okay, so because like I'll tell you now, what we do right now is not purely smart money. Okay, because we have added Malaysian support and resistance into it. Okay, so the way we mark out the POIs are completely different from how smart money traders mark it out. Okay, so because we have marked out, like we have added support and resistance into it, so this is way more stronger liquidity and support and resistance. Okay, so this will be strong. I'll show you. Okay, so something like this. So these areas are the areas of interest for us. Okay, so something like this, the order block, this is the breaker block, and I'll show you rejection blocks once we get into the charts. Okay, so same thing in here. Same thing in here. Now, what will the retail traders do? They might think that a double bottom is a sign of a reversal, right? A sign of a bullish
yeah.
reversal. So what they would do is, once this breaks, they'll expect a move like this. right? So they'll buy it here, stop loss below the equal lows because they think that it is a strong low. Okay, so now not only those type of traders, some people will call this the W formation, right? The W formation, or is maybe a support and all that stuff. So they try to buy it here, but then smart money knows that there is a pool of liquidity resting below those lows. So smart money will push it down like this. They'll push it down. They'll take out everyone that wanted to buy here and then push it back up like this. Okay, so this is what they would do. This is what they would do. So now, what is the order block in here? Okay, what is the order block in here? The price level that they use to push the market down. So your order block could be from here, because why? There's this is where the last sell started, right? Or it could even be in here. Okay, it could even be in here, because now this issue comes, right? You have no idea which one to use. There'll be too many POIs. Okay, so I'll show you how to refine them. Okay, I'll show you how to refine them. So once again, now this right here could be called an order block. So the price level, okay, it's a price level. What's the breaker block? The breaker block will be the last bullish candle before the down move. Okay, so a breaker block could be here. A breaker block could even be here. Okay, a breaker block could even be here. Okay, so I'll tell you which one to use, because once we switch time frames, you will understand which one to use. Okay, so I will show you examples. So you get this right about order blocks and breaker blocks.
Yeah,
Now
yeah,
next thing,
yeah.
let's talk about these rejection blocks, because they are very important. Okay, they are very important. So let's see some examples, and then yeah, let's see, where do we have clear ones that I could explain? Yeah, something like this. Something like this is what we call a rejection block. So yeah, if you watch the previous videos, you know how we use the base of the wick as a point of interest, right? The base of the wick
Yeah,
as
yeah.
a point of interest.
Opening
But
of the
remember,
wick and
yes,
50%.
exactly. Okay, the 50%, forget that. Okay, we're not going to use the 50% anymore. Okay, so
Forex.
we're not going to use the 50% anymore. Completely take it out of your trading model. Okay, so we're not going to use the 50% anymore. We will only be using the opening price of the bearish candle, or else, okay, like necessarily it's not the opening price of the bearish candle. Okay, it is not the opening price of the bearish candle, but the closing price of the previous candle. Okay, the closing price of the previous candle. Like, it's very simple, because the opening price of this candle is obviously the closing price of the previous candle, right? But the
Yeah,
thing is, like, once you switch brokers, you will see some issues, right? You'll see gaps, because the opening price, the closing price of the previous candle is here, but the opening price of the next candle is somewhere around here. You'll have a gap. Okay, so then you'll have no idea which one to use. So remember, always focus on the closing prices of candles. So because according to support and resistance, a resistance is something like this. Okay, a resistance is something like this. We call it the A formation. Okay, or as some people call this a last resort or whatever. Don't confuse the names, okay, because the names are not necessary. As long as you understand the logic behind it, it's more than enough. Okay, the names aren't
yeah.
necessary. So the formation like this is what we call a resistance. So like this. Okay, so now look at this. This area right here, if you look at it on a line chart, what is it? See that? This formation. Okay, so can you see this formation right here? This one. Okay, so this right
Yeah,
here
yeah.
is what we call a resistance. Okay, that is what we call a resistance. And same thing, this right here is what we call a support. Okay, the
A
V
support.
formation, the A formation and the V formation, something like this. Now, obviously, this did not hold. I'll tell you why, because when the market is bearish, the supports are not going to hold anyway. Okay, so see, this formation is what we need to see, a support like this. See that? This right here. Okay, so A's and V's. Okay, remember, we'll be using the line chart a lot too. I'll explain more. Okay, so something like this. Now, what happens when this breaks? Now, first it was a resistance, but once it breaks, what happens? It acts as a support. Okay, simple. Okay, first it'll act as a resistance, but if it breaks, it will act as a support. So we can
Support.
expect a move like this. Okay, so it always moves from support to resistance, support to resistance. I'll show you examples, don't worry. Okay, so simply a formation like this, we can call it a resistance, a support, or else a rejection block, whatever you prefer. But as long as you understand the logic behind it, that's enough. Okay, so it doesn't matter what name you call it. Okay, so something like this. Something like this is what we call a resistance. Okay, this is what we call a resistance. So now, also now, I'll show you another example. Let me put the replay tool somewhere here. Okay. Now, if I ask someone, what is the order block in here? Okay, what is the order block in here? Not the whole thing. If you mark it out like that, that's wrong. Okay, because what is the order block in here? The order block in here will be the opening price of the bullish candle, the body of the candle, or else the closing price of the previous one. Okay, so this right here is what we call the order block. This right here is what we call the rejection block, or else according to support and resistance terms, what do we call this? We call this a resistance, and we call this open close levels. Okay, we call this open close levels. Once again, names are not necessary. Okay, as long as you understand the logic behind it, it's more than, because people call it different names. Okay, so if you understand the logic behind it, it's enough. Okay, so now look at this. Look at this price level. If I go to a lower time frame, do you think anyone will have an idea what this price level is? No idea, right? What is there?
No.
Nothing. Okay, nothing. But what happens? Look at this. Look at the reaction from that level. Look at the reaction from that level. Because why? Okay, because this right here was the 4-hour order block's price level. That's why I told you an order block is not a candle, it is not a zone, it is a specific price level. Because can you see? First of all, it acted as a support. Can you see it? Tapped, it started going
Yeah.
up. But now it is broken, then what happens? It will act as a resistance. See that? Okay, so simple
Yeah.
stuff, but you must understand the logic behind it. Okay, so simply we will be focusing on closing prices of candles. Okay, I'll tell you why. And also, now there is a simple rule to this. Now, let's say the market has tapped this already, like this. Let's say the market has already tapped into this resistance like this. Okay, so we will not use this level anymore. Can you understand that? We can't use this level anymore because we will only be using fresh levels, levels like this. Okay, so if it is tapped in, like if it is tested like this, we will not call it a fresh level. Okay, it is not a fresh level, so we
Oh,
can't use this level anymore. There are times when price once again comes back up and then falls, but most of the time it will not. It will break through it again. So you can only use it once. Can you understand that? Okay, I hope it's clear. And then again, now I'll tell you why I told you to use the closing prices of candles. Okay, so I think there was an example on FXCM. Let's see. Yeah. I don't remember if it was GBP USD or Euro USD. Let me see. Oh, yeah, it was GU. Let me show you. Somewhere around here. Okay. So now if I ask someone, what is the order block? What will they tell you? Either they'll mark it out like this
candle.
or it's like this. This is
Yeah.
what they would do, right? But I told you, what is the order block? Is it the opening price of this candle? No, it is the closing price of the previous candle. This one right here. Can you understand that? Okay. Not the opening price
Can
of
you
this
explain
candle.
it?
Okay. So now it's like this. I told you always use the closing prices of candles, right? The closing prices of the candles. So now, but the thing is now, the way the common traders mark out an order block is like this, right? Maybe like this, or it's from the opening price of this candle, the body of this candle right here.
Uh,
That is
can
what
you
they call an
explain
order
it
block, right? Okay.
once
So
more?
yeah, now simply what you should use is not the opening price of candles. Remember, it is not the opening prices that we're dealing with. Okay, we're not focusing on the opening prices, we're focusing on the closing prices. Can you understand that? The closing prices. So, like, you know how a candle is formed, right? A bullish candle, like it opens here, goes down, goes up, closes here. A bearish candle opens here, goes up, goes down, closes somewhere around here. Okay, so simple stuff. So now in here, are you going to use the opening price of this candle? No, opening prices has no significance at all. Remember that very well. Okay, the closing prices, that is what you should deal with. Because now if I just put a line chart in here on the opening price of, I'm sorry, if I put a line in here on the opening price of this candle, if you go to a line chart, where is it? Out of nowhere, right? In the middle of nowhere. But if you put it to the closing price of this candle and then check the line chart, where is it? On the resistance. See that? Okay, so always
Yeah.
remember to focus on closing prices of candles. So now when I say an order block is not the opening price of this candle, but the closing price of the candle that
Closing
is
price.
before it, that is in here, this one. Can you understand? Because this closed here, this opened here, so we do not know why they gave you a gap, because that gap is present on some brokers. We don't know why, but always make sure you use the closing prices of candles. Can you understand that? Because now, look at this now. Most people will tell you, oh, this is the order block, the body of the candle. Let's wait until price gets here. But if you go to a lower time frame, look at where price is going to react from. Okay, there it goes. Where did it react from? From here or is here? Now, do you think anyone will have an idea where it tapped into? No idea, right? No idea. So that's why
No
I told
idea.
you, use the closing prices of candles. Okay, I always make sure you use the closing prices of candles. I'll show you more examples. That way you will understand, because like the way we mark out POIs here will be a bit different. So until you understand it, let's go through some examples. Let's see. Where were we? The example we were talking about. Yeah, in here. Let's see. Yeah, look at this one. Look at this one right here. Okay, now in here, if I ask someone what is the order block, they might mark out this thing, right? Right? That's the order block, right? For them, because the last push up before
Clear
the push
add-on.
down. Then they'll tell you it is mitigated. Why? Price has tapped into it already. But what is the order block in here? I told you what the order block is, right? Is it the opening price of this candle? But
Closing.
no, the closing price in here. See that? Now has it been mitigated? Has that price level been tapped into yet? No.
Uh,
Yeah.
Color of candle does not matter. Uh,
Colors doesn't matter. Okay, so you can even have
okay.
both the colors black. Okay, like because all you need to do is
Oh.
just use a line chart, and then wherever in the line chart you have these little spikes, you can